Did you know that the bull market of the 1990s went up almost 600%? And the bear market of 2007, 2008 went down about 56%? That's a huge difference. In this video, I want to talk more about the cycles that happen in the stock market, how much they move up and down, and how you can take advantage of this to increase your wealth. Hi, I'm Camille Gaines. I'm a personal finance author and I've been investing for over 30 years. Here I share what I have learned on this adventure. I've lived through a few bull markets and a few bear markets, and boy, hindsight sure is 20/20, right? A few days ago, I did a whiteboard video and it showed how the cycles are up and down and how this relates to the economy and interest rates. I'll put a link below where I did that video, but I wanted to give you a little refresher, and I'll do it here because it's a little bit hard to do the videos on the whiteboard. And I wanted to show you this, and I'll give you a brief refresher here. And I thought of something after I showed you this video, and that was that you can't see from the illustrations of how much of the stock market swings. You don't realize, and even from looking at stock charts, you don't easily see how dramatic these increases and decreases are. And when I started researching this to put together this video for you, I realized how much more the stock market goes up when it goes up than it goes down when it goes down. But I also realized how much more painful it feels, because as humans we tend to gravitate toward those painful feelings. We remember the fear and the pain more than we remember the good things. As humans, we're programmed that way because we have to be fearful in order to survive, or we had to in the olden days, but that's another video. So let me show you on this chart that I've drawn here. You'll see down here at the bottom of the cycle that interest rates are going down at the bottom of the recession, after a recession or during a recession. Interest rates go down. The Federal Reserve lowers interest rates because they want to stimulate the economy. They do. Stocks start growing, the economy starts growing, and then stocks start going up. And then here at the top, things are growing too fast. The Federal Reserve increases the interest rates to slow things down. Sure enough, things do slow down, usually a little too much. Stocks start going down, and then down here at the bottom, real estate is cheap, stocks are cheap, and it feels very scary down here, like you shouldn't ever invest in anything ever, although everything is cheap. And at the top, it feels wonderful, and it feels like it will go up forever. So that's the essence of what I shared with you in the whiteboard video. And so these are somewhat logical sequences. And I shared also, and that's the point of this video, is if you can somehow take advantage of these swings in the cycles. You can't pick the exact top or the bottom, but if you can have an awareness of it when you do things like put a large amount of money in the stock market, or buy a home, for example, you can significantly change your wealth accumulation. You can have a significant effect on the amount of wealth that you're able to create and accumulate over a lifetime. Now, if you invest regularly, which is wonderful, into traditional investments like stocks, and you do so regularly, then you're going to naturally be buying into the market when it's higher and when it's lower. That has less of a dramatic impact than if you do something like you get a large sum of money, perhaps a bonus from work, or perhaps you sell something, or that is of major significance, or you inherit money and you're not sure what to do with that money. And when you put it all in at the top of a market versus at the bottom of the market, those are the kinds of dramatic effects I'm referring to, those larger amounts of money that are put into investments, even in your home, because that is the largest investment that many people make. Now, what I wanted to mention to you, and I want to look at my notes here on this to make sure I get the information correct. Here's what I really wanted to share with you on this video. From August of 87 through December of 87, or until December of 87, the stock market went down 33%. Okay, that's the S&P 500, about 33.5%. From March 2000 through October 2002, the S&P 500, which is the index you've heard me talk about, went down about 49%. And then from October 2007 to March 2009, the S&P 500 index went down 56%. Okay, those are double-digit numbers, 33%, 49%, 56%. It feels, big. Yes, absolutely. But let me tell you what happened in the bull markets. From December 87 through March 2000, there was a 582% increase. Okay, that was the percent increase, 582%. That was the great bull market of the 1990s. I remember it well. We all wanted it to last forever, but it didn't. Then we had the challenging decade of the first decade of the 2000s. But speaking of which, October 2002 through October 2007, the stock market, S&P 500 index, went up about 101%. So these are triple-digit increases. Now that second one is barely a triple-digit increase. So we didn't get a great rise during the bull market of that first 2000 decade, and it was sandwiched in between those devastating losses in the early 2000s and in 2007, 2008. So, that wasn't as dramatic. But what I wanted to explain is that, or point out in this video, is how much markets can rise during bull markets and how much they can fall, or typically do fall, or have fallen in recent history of bear markets. And if you can somehow ease into those, as my dad used to say, if you can ease in near the bottom and ease out near the top in some of your larger investments, it can have a dramatic increase on your ability to create and accumulate wealth. That's what I wanted to share with you in this video. If you found this information helpful, I'd love it if you would give me a thumbs up at the bottom of the video, and I appreciate your watching. I'll put a link below in the description area to the whiteboard video so you can watch it as well. Thanks.